So let me get this right. We had Nvidia earnings today. We had Federal Reserve minutes come out, and look at what the stock market did. I'm going to give you a hint on as to why it's just kind of spiked. Look at Nvidia. Look at the NASDAQ 100 QQQ right here. It doesn't have anything to do with any of what I just mentioned. We got even larger news out today. And who would have even guessed? Trade court strikes down Trump's Liberation Day tariffs, saying they were illegal. I swear you can't make this kind of stuff up. A federal trade court ruled President Trump didn't have the authority to impose sweeping tariffs on virtually every nation, voiding the levies that have sparked a global trade war and threatened to upend the world economy. The decision on Wednesday from Court of International Trade blocked one of Trump administration's most audacious assertions of executive power under the International Emergency Economics Powers Act of 1977 and sets the stage for a possible appeal by the White House. And look at stocks just mooning off of that. Because that's great news. That's where all of the uncertainty is. I wouldn't say the event traded market goes away though, but here it looks like we are loving it. And look at that, Bitcoin's kind of down on the news, but Nvidia spiking, QQQ spiking, and we still got other stuff we got to get into this video. So Nvidia earnings came out today, and what we've seen is that Nvidia beat. The revenue came in at 44.1 bill, up 69% from a year ago versus 43.3 bill expected. Adjusting earnings per share up 33% from a year ago, up to 81 cents from 73 cents expected. Revenue guidance, this was a problem. So Nvidia beat, but this was less than it has beat in the past. Let's go back and look at the chart. We'll put it on the big chart. And this company is a huge company. This market cap is right here. We can see, well, you probably can't see. I'll scroll up a little bit. So this market cap, just think of market cap as the total amount of money just in this stock, in this company stock. $3.29 trillion. That's beyond huge. Like, that's unimaginably huge. So the SPY, the Dow Jones, well, maybe not the Dow Jones, the NASDAQ, QQQ, NASDAQ 100, all of those indices are heavily weighted by the moves of Nvidia. And it beat, but it beat less than it has in the past. So this beat of 728 million was the smallest beat since April of 2023. It's still a great, well-positioned company, and it's still an enormous company, and it's still beating. But this is kind of where people seen some hiccups with these earnings. Forward guidance reflects the company will lose out on $8 billion in revenue due to in July due to the export restrictions on the China biz it has. And this was really due to the trade talks and tariffs through Trump. So I wonder if any of that changes with the strike down by the courts we got today. And I'm waiting for more updates. We'll see these come. I'm sure Trump will announce on it. Maybe he even tries to fight back. So who knows how much of this optimism we've seen in the market just today from that news. But you can see Nvidia beat. And then that news came out. And let's go back to QQQ, NASDAQ 100. Just straight up from that. Like, you could see where Nvidia came out. And then that news came out and just straight up. So we're testing highs again. Like, I wouldn't be surprised if the stock market entirely just breaks a new high here pretty soon. So we got to go to like 538 is where it really sits. But let's just say 540. We're not too far away, sitting at 527 after hours for QQQ. Now, we also got the Federal Reserve minutes out from the FOMC's meeting. They presented us some worries. The worries were mainly along the lines of stagflation, and this is due to these trade talks. So it's even more uncertain because, all right, well, the court blocked the trade talks or the tariffs because they were unruly. So the higher inflation due to tariffs that the Fed worries about or worried about at their last meeting kind of is even more unclear now, because do they go away? Do they come back? It seems like they're going to go away if the court blocked it, but who knows if Trump tries to fight any of this or not. Now, they talked about how the higher inflation expectations due to tariffs that consumers and investors, market participants in the economy have about inflation going higher, in a way self-fulfills it, because if people expect higher prices, what are businesses going to do? We're going to give you those higher prices. You're expecting it anyways. You lucky goose, how'd you even guess right? Now, due to these higher inflation worries, so higher prices, they believe that the odds of a recession are much higher. And they also put that the recession was seen as their baseline forecast. So this is what they're expecting, is a recession down the road. Again, I don't know how any of this changes. I'm still learning here. But they're still waiting to see as to whether they should cut rates. They're cautious to cut rates, although they expect the labor market. This one was interesting. The labor market to begin to weaken by the end of this year and stay high all the way through 2027. Wow. Now let's continue down this road. So let's just pull up and look at the stocks, because we're going to go back and talk about stocks. So we got our two big catalysts today. Really three of them now, because we got the trade talks, the tariffs blocked by the courts. Nvidia earnings came out. They beat. They beat a little less than they usually beat, but they still beat. Still phenomenal company. Fed minutes, they're worried about how the economy goes forward. Let's pull up a few other ones so we could just look at them. So we got QQQ. Let's pull up XAUUSD. Let's pull up the DXY, so the US dollar index, and let's pull up BTC USD. Oh wow, did the dollar jump on that news? Wow, I'm gonna scoot all this over so we can just look at it. All right. Now these stocks, people are buying the freaking dip, and you've really been rewarded if you've done so. Investors are betting that the worst is behind us in the stock market, and they're referring to this type of trade called the taco trade. So the taco trade was coined by Robert Armstrong with Financial Times, and what it stands for is Trump always chickens out, in relation to these tariff threats, and then walking back like, hey, we're gonna do this, and then we're not, and then we're gonna do this, and then it starts getting a little tight in the room, and then we're not. So people are buying the dip, betting that Trump's kind of bluffing in a way. Now, that's really been good, and now even more good with the tariffs block. Like my whole plan video, like it's completely changed. Like that's how uncertain it is out here in the macro environment. We don't know what the heck is going on. And imagine just trying to learn all of this and then like present it. Ugh. Now, what economists are saying is that what determines the next 15 to 20% move in markets isn't really these tariff talks. It's what happens in the economy as far as jobs and the consumer. And the Fed minutes gave us a big look into what they think could happen, which would be stagflation, a period of slow economic growth, high unemployment, and inflation problems. And with them not wanting to cut rates until further settling of the dust that's making it real cloudy to forecast what's ahead of us, it just gets more uncertain out there. Now, the selling may go away. That's behind us. We haven't really seen much selling. If anything, the market's been straight up. And we're leading into June, and there are a few different scenarios that people are talking about that are plausible and happening. One, a huge drop, which is called the June swoon. The next one would be a summer rally. Kind of seems like stocks are rallying. Bitcoin's reached a new all-time high. Gold's reached a new all-time high. Stocks have not yet. Well, wait, did they? Let me go back to the day chart on this. When was this all-time high for QQQ? I think you got to go to the week chart. So it's all-time high. Whoa, so it did reach a new all-time high this year. So February 28th. But we haven't reached a new all-time high yet, although gold has. Gold's just been straight up. And then Bitcoin reached a new all-time high. So interesting. But there is a third scenario that they're also saying that could happen, and that's no real big gains, no big losses. So far, that's playing untrue. But as far as the June swoon, May, September, October, that's where we're really seeing larger average losses that are greater than that of June. So that could possibly be off the table, and there's not much data supporting a huge drop, although we are getting back to all-time highs, and usually around all-time highs, that's where people want to take profits and, you know, just offload some bit, readjust their portfolios. And if everybody jumps at once, not saying the entire stock market trades like a meme coin, but in a way that psychology is still there. All-time high, sell. You're not going to want to go all in margin, empty out your bank account because it's on a fire deal because it's at an all-time high. You usually do that at drops, and we've seen that happen when the market dropped considerably and how fast it's risen back up. So as far as the June swoon, they think that one's kind of off the table, and it's still an event-driven market. Data supports that a huge drop probably isn't likely, but with these trade talks still ongoing, who knows if they disappear or not. Near all-time highs, high interest rates still, and the Fed gave a hint like, hey, we're still waiting. Like, don't hold your breath on us to cut. We're probably going to make it through the entirety of summer without cutting. Who knows if y'all are even going to get that rate cut in September, which let's see. I don't know if it updates after hours, but let's pull up the CME Fed Watch tool. I don't even care, just for fun. 97.8% chance they keep it the same. September is where everybody's seen a cut, and now it is less than 50%, so we're at 48.6% that people expect the Fed to cut at. What about December 10th, 2025? So their final meeting of the year. The highest odds put us at still 2 cuts, 40% expected. So I'm interested to see if this changes tomorrow or where we really end up at, but we still got these high rates, and I don't know, does the rally kind of seem far-fetched? Because before tariffs were ever an issue, it just takes us back to these interest rates being high and mortgage rates being above 7% again. Borrowing costs are still high for businesses and consumers. Are these really justified? But we'll get into more talking about the consumer here in a bit. I want to pull up, we'll leave gold, we'll leave Bitcoin. We got DXY, so we got the US dollar index. And let's pull up TLT, longer bonds, 20-year plus bonds. And let's pull it up on a larger chart, on a longer chart. You know, I'm fine with this. We could look at all the lines. I love the lines. So despite stock strong recovery, there are really 2 assets that's really had trouble. They're still in the struggle bus. And the first one is the US dollar, which is this bottom right chart right here, the DXY, the US dollar index. And it's still more than 8% weaker compared to some of its peers in baskets, compared baskets to its peers. So like the euro, the yen, you know, all of these other large currencies. Now, many are believing to think that the dollar's 60-year reserve status is headed down the same path as some of these bankruptcy candidates as Sears and Blockbusters, and it's really funny to compare it to them because the share of global reserves which is the amount of USD held by foreign central banks, has sharply declined the past 2 decades. Now, the US dollar is still about 2/3 of global debt, so it's not like it's just disappearing off the face of the earth. But according to the International Monetary Fund, it has fallen from 72% in the year 2000 to around 56%. Later mentioning that there are no replacements currently, but that this is just alarming. Look at such the large drop since just 2000. The US dollar index has fallen nearly 11% in the last 3 years as budget deficits and debt levels continue to rise, and that the collapse of the dollar, they point this out, I thought this was interesting, may not just be like a single collapse, but rather a long period of time. Like, think about how long it'll take just all of them dominoes just keep on knocking each other down. So a slow, gradual drop due to more so poor decision making, like those companies that have disappeared, right? The CEOs or financial controllers of those companies really took those companies into the dirt. So these poor decisions could revolve mainly around the spending deficit, which is still an issue right now. Who knows if the trade threats are still a thing or not that impacts the dollar, if companies forget, like, hey man, just a week ago, your president of this country that represents this dollar, this greenback, just put tariffs on us. So you know what? We're gonna raise tariffs up a little bit on y'all. Like who knows what could happen out of this? Now, there's another asset that's really been in the struggle bus, and I kind of gave y'all a hint. TLT, 20-year bonds, plus 20-year plus bonds. Those have also kind of been in the mud. Now, these long-term treasuries have been rising pretty much since the election, right? Ever since Trump got elected. And this plays into the same factors. The national deficit due to spending, especially with the big, beautiful bill, which Elon Musk voiced that he's not really a fan of it due to the massive spending, because the massive spending increases the need for the government to issue more debt if they're not able to fund it through revenue, tax collection, tariffs, which increases treasury yields, which increases borrowing costs and makes it tougher, right? And then the trade talks with the other countries who buy US debt. So just like with the sourness in their mouth, like that sour taste doesn't just go away. Like, you don't forget this kind of stuff. So they might be a little less inclined to load up the boat with US debt when it's available. Long-term treasury yields are near a 21-year base breakout. So if the 30-year closes above 5.25, which let's just go to EC and check it out. We want to look at the 30-year bond. So if this breaks above 5.25%, come on, you can load. I promise you can load. I don't want to watch the live stream. So if it breaks this higher term cycle, this could be a new long-term cycle that we could be stuck in, where it's a sign that we're in a longer term cycle where we have higher borrowing costs for consumers, businesses, and the US Treasury. And like I just said, that's kind of tough. When borrowing costs are higher, people can afford to spend less. So we're right at 5% and we've seen a drop. Let's go year to date. Looks like we're kind of spiking up a little bit, but I'm interested to see how everything moves tomorrow at open. So I might try to get a video out before work tomorrow just to kind of see what happens. But last week or the week before, I'm losing track of time, we got a 20-year treasury auction for the US. Came in a little weak. That wasn't a good sign. So today in Tokyo, we got Japan's 40-year note auction, and that was the weakest demand we've seen in almost a year. Now, that wasn't really good just because of what's called the carry trade. And what ultimately happens is people go and they'll get the Japanese yen and they'll hold that currency. Just imagine I'm holding a Japanese yen as a currency. And then they go to a Japanese bank and they buy treasuries, which pay a certain yield or whatnot. And they borrow against that. Then they take that money because the interest rates they're really low, just because Japan has a history of having lower inflation. So they'll borrow super low in the yen and then go buy higher yielding assets like the US treasuries or US assets or other countries' assets, right? Other countries or companies outside of Japan. And what that ultimately does is creates more money to invest, so a higher supply of money out there investing into assets. So when the Japanese 40-year note auction comes in weak and yields go up a little bit, the spread you make between the US Treasuries high yield, which is super high right now, and the Japanese yield kind of like lower, or it doesn't make as much sense, right? So then they like pay off their debt. They got to sell some of their assets to do that, and kind of causes this rebalance in asset values, really, to bring it down. So Japan came out and really mentioned how they plan to bring down their yields, which we mentioned ours, how Treasury Secretary Bessent plans to bring down US Treasury yields, especially the 10-year, through adjusting the bank's lending ratio or whatnot. Japan plans to bring down their yields by issuing less long-term debt and more short-term debt. And who knows how that actually plays out. Now, we got one more article I wanted to really cover real quick, and it's called the US. Oh no, did my computer just freeze? All right, let's exit out of Weeble. And we had the economic well-being of US households in 2024. We got some decent information here. So American finances are holding up pretty well. And this was conducted in October of last year, so October 2024, among 12,400 adults. And of them, 73% of adults are doing okay or comfortable financially. And that's up from 72% in 2023. So we're 1% better in 2024 versus 2023. 63% of Americans report they can cover a $400 emergency using cash or available credit and then turn around and pay off the credit. Americans have continued to maintain savings at levels consistent with the previous 2 years, while retired preparedness improved slightly. And this will go back to the job market doing pretty well, although in the Fed minutes they revealed that they're worried about the job market, which would lean Americans to have less money to buy the dip with, because these jobs are where the buy the dip money is coming from, and maybe start dipping into their savings. Now, you gotta love the job market, at least, because workers do. Many workers are planning on working longer now. So workers do, 75% of workers plan on working into retirement, and 29% of retirees already do. And this comes from the Employee Benefit Research Institute's confidence survey. And it's just showing that more people are expecting to work longer into their lives, and people are living longer as well. So this has a few different things. One of them, increasing costs, inflation, right? Look at how much asset values have increased. Stocks, food, the value of the dollar going down, homes, all of these different assets have gone up over time. So you'd expect that to continue into the future. Now, two I didn't think about was purpose and social engagement. I heard this statistic one time that usually when people start into retirement and they start doing less, sleeping more, they don't live much longer after that. Their life ends shortly after that, maybe a few years, some even a few months. What pulls you out of bed just kind of goes away. So it makes sense that many people want to work longer for purpose and social engagement, not just because of cost. So it sounds less depressing that way. But we got a busy week, y'all. We still got more to watch. It's not over with. We want to hear back from what Trump has to say. How are these stocks going to keep on performing based on what Trump says about these negotiations? Does he fight back? Does he not? Do these other countries kind of retaliate now that Trump's limited? Because I'd imagine this plays into these other countries benefits now because like he's limited. We still got more data coming out. Just get on Market Watch's economic calendar. You can find out more about that. But yo, this is crazy. Literally crazy. And I'm here to cover it. Yeah, have a good one.